Hello, everybody. Welcome to my channel. Today, I decided to start a series on velocity banking and basically all the flaws that I found with it. I'm going to do a series of videos basically debunking velocity banking. Today, we just have my intro, and in the near future, I'll follow up with several videos, slowly building on some basic financial terms and ideas, finally culminating in either one or a series of videos showing why velocity banking and their main concepts don't work. So today we have the intro, and that's the purpose of the series, is basically to show all the flaws of velocity banking, define basic financial terms and concepts, showing the examples, easy to follow examples of everyday finances, loans, and banking, and finally debunking specific concepts and examples promoted in velocity banking. So the short definition, what is velocity banking? Supposedly, it's a revolutionary way to increase your cash flow and pay off all of your debt faster than, I guess, what they define as what you would normally be doing. Some major concepts, and I admit it's kind of hard to nail down any of the actual concepts from the creators of this type of content, because if you ask them directly, they generally won't specifically precisely define velocity banking. They'll just go into a video and they'll go, hey, that's velocity banking. Hey, this is velocity banking, but they won't actually nail down specifics. I've watched several videos. Here are some concepts that I've culled from my experience watching these videos. Velocity banking involves keeping your money in motion. Okay, constantly transferring your money in and out of accounts. You get paid, your money goes into the checking account. Don't keep it there, transfer it out immediately into a credit card account, and don't keep it there for too long. Transfer it out to another account, and so on and so forth. Uh, Avoiding checking accounts or banks. Banks are bad. Don't use your checking account to pay your bills. Get paid, get your direct deposit in your checking account, immediately shift that money into a credit card. You don't want to keep your money in the bank account, in the checking account, because that means the bank is somehow taking advantage of you. Put it in your credit card account and defeat the banks. All right, so these are just overviews. Obviously, there's a lot of flaws in this type of thinking, so I'm just going over the points, and then in the future videos, I'll debunk each one of them. Increasing your cash flow by using credit cards, lines of credit. So there's this really bad idea that if you use lines of credit and credit cards to pay your bills instead of just using cash or checking account, that you somehow increase your cash flow. And there's several problems with this idea. And again, going forward, we'll take a look at what cash flow is and why this is an incorrect idea. The concept of using some sort of debt tool to pay off debt. So basically, use a loan to pay off a loan, which not in all cases is a bad thing. It's just that the way I've seen it implemented in velocity banking is very bad. So oftentimes they'll say, hey, you've got a car loan at 7%. That's really bad. Take out an additional loan on a credit card for 10% and use that 10% credit card to pay off your 7% car loan. Okay, we can see an obvious flaw there, but anyway, they'll do a mathematical example and somehow try to convince you 10% is better than 7%. Objectively wrong. That is just objectively incorrect. They use this concept of chunking payments, again, using higher interest to pay off lower interest. And one example that I'm going to do in the near future was one of the most egregious ones I've seen. Take out a credit card or a personal line of credit loan at 21% interest, use that to pay down your mortgage, which has a 6% interest rate. And that's actually a really interesting example, and a lot of people are fooled by it. So I'm going to take a look at that in depth in the future. Right off the bat, we can see that that's a bad idea. This idea of using the same dollar twice or using the same dollar more than once. So the idea touted there is that if you have a bill to pay and you use your checking account and pay that bill, you lose access to that money. Well, we call that paying a bill. Oh, if you put it into your credit card, put your paycheck into your credit card instead of your checking account, and somehow use your credit card to then extract cash and pay your bills, you now have access to the same dollar more than once, and you can use that dollar twice to pay off two bills. And this is just, it's not true. Anyway, number 6, amortized loans are bad. Personal lines of credit are good. You don't want to have an amortized loan for your mortgage, car payment, student loan, etc. Take out a personal line of credit. And what happens here is when they give these examples, they'll either use a personal line of credit at a higher interest rate than whatever your mortgage or car loan is, or they just won't tell you what the interest rates are in the example. So you'll watch a video, they'll go, hey, you have a car loan. Let's pay that off by taking out a personal line of credit. Personal line of credit has 18%. Let's use that and pay off the car loan. And then they'll never tell you what the car loan rate is. And I can absolutely guarantee you, if the car loan rate is anything less than 18%, it's actually a bad idea to take out an 18% loan to pay off a car loan if it's lower, if your existing rate is lower than 18%. Anyway, these are the concepts that I've called from my experience watching the videos, and we'll address specific examples, which I've already kind of given you a preview in future videos. All right, my first experience with velocity banking, my best friend, who we often talk about finances, paying bills, mortgages, investing, et cetera, sent me a text one day. He goes, hey, can you check out this video? And he told me, well, I watched this video and instinctively it doesn't make sense. However, I watched the guy write the numbers on the whiteboard and oh my God, it turned my world upside down. And basically the example was one I just already mentioned. He watched a video of a guy doing this revolutionary thing called velocity banking. And he gave a scenario and, somebody had X amount in income, Y amount in expenses, and part of their expenses was a monthly mortgage. The mortgage had a 6% interest rate. And then he said, well, if we take out a personal line of credit or a credit card or a loan at 21% and use that money to pay down the 6% loan, we come out ahead. And then the big deal here was that 21% loan is simple interest, and that mortgage is amortized interest, and that's the bank doing all kinds of trickery and cheating you out of your hard-earned money. So you can use 21% at simple interest, and you can pay down that 6% mortgage because that mortgage is bad. And I'll go into further detail in a later video to show you exactly what he's saying and why he was claiming that the 6% mortgage was inferior to the 21% credit card or line of credit. Anyway, my friend saw this video and he was taken aback. He said, well, this guy actually proved that 21% is 6% better than 6%. I don't believe it. And he sent me the link and I watched the video. And to my amazement, my whole universe got turned upside down. I watched the video and I went, oh my God, this guy just proved that 21% is better than 6%, better financially. And I couldn't believe it. I said, everything I've ever learned in my entire life, this can't be happening. And I checked the math, I checked the arithmetic, it all checked out, it all worked out. And I couldn't believe it. So I don't remember if I went to bed and woke up the next morning or if I just took a break. And then so I watched several of these videos and I watched the same video over and over. And then I finally realized the problem. And the short story is, and I will do this mathematically later in another video, the guy was comparing the amount of interest that you pay on a $12,000 balance on a 21% interest rate with the interest amount on 1 month on a 6% mortgage on $200,000. Okay, so if I'm paying 6% on 200,000, that's obviously going to be more than 21% on 12,000. And that was what had escaped me and my friend when I first watched the video. And then when I found out, I wrote to my friend, I said, hey, the universe is not collapsing. Actually, here's what's happening. And the reason that these creators get away with it is because they do this really fast and there's not really time for you to think. And he calculates out and he goes, 21% at 12,000, 1 month worth of interest is X amount. And then you have your mortgage loan and you're paying Y amount. Look at how much more interest you're paying. Well, that's because he's comparing 21% at 10,000 versus 6% on 200,000. Now, if you did a fair comparison, 21% on 12,000 versus 21% on 200,000, or 21% on 12,000, or you know, versus 6% at 12,000. The 6% is going to win every time. So anyway, that's what got me started. This happened in 2020. And then, I made comments on several videos and I went on with life. 2023 comes along. YouTube starts showing me velocity banking videos and my suggested videos again. I started going down the rabbit hole again. And then I started watching videos by different content creators again, like different ones than before. Um, then I finally decided to do my own series, Debunking Velocity Banking. The reason is I found that a lot of creators don't seem to understand the terms, concepts, or calculations they're using. And I verified this before in 2020. I saw several different creators doing the exact same examples, 21% versus 6% mortgage. They had the same numbers in terms of income, cash flow, expenses, mortgage payment, etc. I got in touch with one of the creators and he told me, oh, yeah, I'm following the example set forth on the book. Said, well, what book? Oh, this author wrote a book on velocity banking. So I realized they're all basically following the same script and same manual, regurgitating examples without actually understanding what their terms mean that they're using. I actually did find the book online. I was going to buy it just so I could read it and, see all the rest of the information. I decided, why should I give this author more money to buy his book when I know that it's, abject nonsense to begin with? So I didn't do that. This was back in 2020. Fast forward to 2023. Again, I started watching videos. I started commenting on them. And again, the creators aren't understanding the concepts or calculations. A lot of the content, due to their misunderstanding, is misleading or factually incorrect. And this is objectively, verifiably incorrect information, which leads you to the opposite of the desired effect. I believe a lot of these content creators are actually trying to help people with their finances and have positive effects. However, I've posted comments on several of their videos and I've said, look, here's how you're misusing these terms. Here are some examples. And I've written some very lengthy comments. Please, please, please just go online, use your favorite search engine, search what does simple interest mean? What does compound interest mean? What does amortization mean? They use this term amortized interest, which actually doesn't exist. I'll give examples of that in the future videos. And they stubbornly refuse. And I've asked them, I said, well, can you define simple interest? Can you define compound interest for me? And they either refuse to define it, they change the subject, deflect, or they give me a verifiably wrong definition. And then I'll say, well, here's a link to the definition online. Please go look it up. Please just give your followers good information. I'm not trying to put anybody down or burst anybody's bubble, but you're giving people wrong information. You're having a negative effect if they think your information is correct. And I want to see you guys do good work and help people out. Eventually, many of these people banned me from their comments, which I didn't know. I'm not used to creating YouTube videos or commenting on them. But somebody alerted me and said, I haven't seen you comment on this video in a while. Have you been blocked? I said, well, what does that mean? I post my comments and I realized that somehow I have been muted on several of these YouTube sites. So I'll post a comment and though I can see them, if my friend logs in on their account, they can't see any of my comments. One creator I actually called out on this and he adamantly refused. He said, oh no, I definitely have not blocked you and how dare you accuse me. And then he's writing all these comments going, how dare you accuse me of you've insulted my honor, knowing that I can't actually respond to them because he's blocked me. I actually have like 3 or 4 different Google or YouTube accounts, and he actually blocked me on all. Like I posted a comment, I said, haha, well here I am, here's account number 2, and you have blocked account number 1. He goes, no, I didn't do that. And then lo and behold, account number 2 got blocked. And again, this one particular person started disparaging me and going, you keep insulting my honor and integrity and telling me that I'm blocking you, and I definitely am not blocking you, all the while knowing that I cannot respond to that. So I finally said, I'm not going to have my voice silenced. I'm going to take some effort. I'm going to make my own YouTube videos. So here we are. All right. Expectations, short videos or hopefully short videos. I don't know what shortness is in terms of YouTube, if it's 1 minute or 20 minutes. Uh, but I'm going to try to start with short videos explaining key concepts. I'm going to give clear, concise examples. I don't have these fancy whiteboards like all the velocity banking YouTubers have. They've got these whiteboards full of numbers and they start rapid fire writing down numbers and giving calculations and jumping from one place to another. Makes it very hard to follow. At the end, you're mesmerized and you believe everything they say. I'm going to have very clear, small, concise examples. It's going to be on presentation software, very black and white. Okay, I'm going to focus on concepts and summaries of calculations. I don't want to get bogged down in a lot of detail. Of course, you don't have to trust me that my calculations are correct. You can always go online, type in loan amortization calculator, mortgage calculator, auto loan calculator. You can type into your favorite search engine what is compound interest, etc. I highly encourage people to do that. Don't just take my word, don't take somebody else's word. Please, take in information from several sources and then go online and do your own research. Take an online course, whether it's from a community college or just from like a short boot camp or whatever online about personal finance. Verify the information that I and other people are telling you. But I am going to try to focus on like high level concepts and summaries of calculations. So okay, here are the results. You have a loan at X percent, you borrowed Y amount. Here's the Z amount of time, X, Y, and Z, right? X amount at Y interest rate for this amount of time. Here's what you pay in principal, interest, etc. And then for those of you who are inclined, I will leave links and I will share spreadsheets with calculations and so on and so forth. Because hey, why give you all the information if you can't verify it on a spreadsheet yourself? So I will make that available. That's what I was just talking about, detailed calculations as epilogues, links to spreadsheets, and main points, what I just covered, introduction to my series. Next video, we will start introducing financial concepts and definitions. So it's very important that we have definitions for all the terms that we're going to be using. One of the big major flaws that I found watching the velocity banking videos, one, they don't define any of the concepts or financial terms that they're using. Two, those content creators oftentimes incorrectly use several terms such as simple interest, compound interest. They use a term called amortized interest, which in the context doesn't exist. You amortize loans, which means paying loans off over time, but they keep using this term amortized interest. And I've messaged several of them. I said, please look up these terms, search on any website. None of them do it. They just argue back with me that I'm ignorant, which may be the case. I may know nothing. But before we discuss anything useful, we have to define terms. We have to agree on what these terms mean before we use them. Some people have defined some terms like amortized loan, compound interest in a completely wrong way, just factually incorrect way. And then it hit a light bulb, and I said, "Oh, okay. I'm arguing back and forth with somebody in the comments about simple interest and mortgages and amortized loans, and they keep telling me how ignorant I am and how bad amortized loans and how much more interest you pay." And then one day, one of them said, "Well, here's why. This is what amortized interest means." And I went, "Wow!" It blew my mind. I said, "Oh my God, that's not at all how amortized interest works, or how interest on amortized loans work." And the short story is the person said, well, if you amortize a loan, the interest is always charged on the principal amount. So meaning if I borrow $200,000 to buy a house, each time I make a monthly payment, the interest is calculated based on the 200,000 original principal, not on the declining balance as I pay the loan off, which we should all know is wrong. As we pay a balance off, the interest is charged against the remaining balance. But I've had more than one person tell me, well, when you borrow money from the bank for a mortgage loan, if you borrow 200,000, they charge you interest on that whole 200,000 for the entire life of the loan. And that really set a light bulb off in my head. And I said, this is why, quote unquote, velocity banking people argue with me. And that's just absolutely wrong. So before I get to the debunking, I'm going to have a series of videos where we introduce and give examples of basic financial concepts, terms, and definitions. All right, so thank you all. This is my first video. I welcome all comments, discussions, uh, recommendations, suggestions for improvements, or if you have ideas or questions you want, please like, comment, and subscribe. I've learned that from watching YouTube videos, and I will see you in the near future. My next video where we start talking about financial concepts. Thank you very much, and please do hit that like and subscribe button.